massive liquidations, perfectly timed moves. Bitcoin might be manipulated, not by one person, but by powerful players you never see. So what's really happening here? Is this just supply and demand, or is Bitcoin price being controlled? Let's dive in. Bitcoin doesn't just move randomly. In recent years, billions of dollars in liquidations have been triggered in minutes on platforms like Binance and Bybit. Price drops, stops get hit, positions get wiped out. It feels coordinated, but this perception often comes from a cognitive bias. We see patterns even when markets are simply reacting to liquidity and leverage dynamics. The real question is not whether Bitcoin is controlled. It is who actually has influence over the price, because markets are not driven by a single actor. They are shaped by multiple forces interacting at once. Understanding those forces matters more than assuming manipulation, because influence can exist without centralized control. At its core, Bitcoin price still follows supply and demand. Buyers push the price up, sellers push it down, but supply is not evenly distributed. A very small percentage of wallets controls a large share of Bitcoin. This concentration means that a limited number of large holders can significantly influence market movements. Large holders, often called whales, can move the market with a single transaction. When a whale places a large order, it impacts liquidity and price immediately. But this does not mean full control. Whales influence short-term movements, yet they still operate within a broader market where other participants react and adjust constantly. Bitcoin price is not decided everywhere at once. It is formed on major exchanges around the world like Binance and Coinbase. A large share of global trading volume is concentrated on a few platforms. This means price discovery happens in relatively centralized environments. Exchanges matter more than you think. In 2024, the approval of spot Bitcoin ETFs marked a turning point. Firms like BlackRock and Fidelity Investments entered the market. BlackRock's iShares Bitcoin ETF alone attracted billions of dollars in inflows. These institutional flows introduced a new category of large buyers with direct impact on price. Today, institutional flows play a major role in Bitcoin price movements. When ETFs receive inflows, they must buy Bitcoin on the market. When outflows occur, they sell. According to CoinShares in 2025, weekly fund flows can reach billions. This makes institutional demand a key driver of price trends, often more than retail activity. A large part of Bitcoin price action comes from derivatives markets. Indeed, a lot of platforms like CME Group and Bybit offer leverage trading, the use of a smaller amount of initial funds or capital to gain exposure to larger trade positions in an underlying asset or financial instrument. When positions are liquidated, they trigger forced buying or selling. These cascades can move price dramatically within minutes. Market manipulation does exist in crypto. Techniques like spoofing, wash trading, and pump-and-dump schemes have been documented by regulators. The SEC and CFTC have reported multiple cases involving misleading orders and artificial volume creation. These practices are more common in smaller markets than Bitcoin. Bitcoin is simply different from all other cryptocurrencies. Its market is deeper, more liquid, and harder to influence entirely. Bitcoin has significantly higher liquidity than most altcoins. This makes large-scale manipulation difficult, but not impossible, especially over short time frames where temporary influence can still occur. Some argue that companies like MicroStrategy, led by Michael Saylor, are accumulating large amounts of Bitcoin, potentially centralizing influence. Others believe that these same institutions bring legitimacy and stability to the market. This raises a key question. Does institutional adoption reduce volatility or reshape control? Bitcoin is not controlled by a single entity, but it is influenced by multiple powerful actors. Whales, institutions, exchanges, and derivatives markets all interact simultaneously. Each one affects price in different ways. The result is a complex system where influence exists everywhere, but centralized control does not. Bitcoin markets are driven by powerful feedback loops. When price rises, fear of missing out increases demand. When price falls, panic accelerates selling. According to Dalbar studies, investor behavior often amplifies trends. This creates self-reinforcing cycles where emotion and price feed into each other continuously. Retail investors often enter after major price moves. By the time they act, the trend is already in motion. This creates the impression that the market is controlled, but in reality, it is a timing issue. Late entry combined with volatility makes normal market behavior feel like manipulation. Bitcoin price movements are not purely random. They are influenced by liquidity, market cycles, and macroeconomic conditions. Data from Glassnode and Fidelity shows recurring patterns linked to adoption and capital flows. Understanding these factors helps explain price behavior without relying on manipulation theories. Bitcoin is often described as a free market, and in theory, it is. But in practice, price formation happens through exchanges, institutions, and capital concentration. Large players have more impact simply because they move more capital. This creates an uneven playing field where influence is not equal across all participants. At the end of the day, the real risk is misunderstanding how the market actually works. Some believe everything is manipulated, others believe everything is fair. Both views are incomplete because the market is influenced but not fully controlled, and acting on the wrong assumption can lead to poor decisions and misinterpretation of price movements. There is no hidden organization controlling Bitcoin behind the scenes, no central switch, no single entity deciding the price. The market is complex, driven by many participants interacting simultaneously. What looks coordinated is often the result of systems reacting to the same conditions at once. Even without control, power still exists in the market. It comes from capital, speed, and access to information. Large institutions, fast trading systems, and informed participants have advantages. This creates asymmetry, where some actors can react faster and influence price more effectively than others. The real game is not trying to detect manipulation. It is understanding how the system works. Because once you understand the rules, once you understand what moves the market, you stop reacting emotionally to price movements and start making decisions based on structure rather than assumptions. And that's how you can win. So, is Bitcoin price controlled? Not in the way most people think. There is no single entity pulling all the strings. But the market is not neutral either. It is shaped by capital flows, institutional activity, and market structure. And those forces can create movements that feel intentional. The ultimate difference is in perspective. Amateur investors see manipulation. Professional investors see structure. They understand how liquidity, leverage, and capital flows interact to move price. And that understanding changes how they interpret every move in the market. That's the way you need to follow. At some point, you have to stop blaming the market. Price will move fast, sometimes irrationally, but reacting to every move is exactly what puts you at a disadvantage. The real edge comes from consistency, from having a plan and sticking to it when things get uncomfortable. Bitcoin price is not controlled, but it is not random either. It is a system shaped by powerful forces that most investors do not fully see. If you want to explore the world of crypto, don't chase miracles. Educate yourself, because in this world, a simple click can change a life. But only knowledge can protect your future.